Okay. Today's session is chapter 5, costing method. We are focusing on process costing. Previously, we will discuss the job costing, and today we are focused on process costing. Lecture outlines, of course, session objectives. Explain when process costing is system appropriate, the meaning of process costing. Accounting treatments, there are three things here: normal loss, abnormal losses, and abnormal gains. Three words are there: normal loss, abnormal loss, and abnormal gain. Prepare process and normal. So we will prepare the process accounts for these normal loss, normal losses, and abnormal gains, and even for work in progress. Then there is another word, calculate equivalent units. We will discuss about equivalent units, and we will be discussing two accounting methods: weighted average method and the first in, first out method, WACC and the FIFO. Basically, throughout this lecture, what we will do is we will discuss the accounting aspect of process costing. When we discuss the accounting aspects, we will discuss basically normal loss, the concept of normal loss, abnormal gain, equivalent units, and we will be preparing the process accounts under two methods: weighted average cost method and the FIFO. That is the session outcome. Okay, coming back to the illustration of process costing. So when you think about the process costing, of course, like other manufacturing setup, like job costing, like other manufacturing setup, we use inputs for the process. So we will label as direct material and direct labor and manufacturing overheads. Direct material, of course, we will discuss in separate, but when you think about this direct labor and direct overheads, these two can be labeled as conversion cost. In certain cases, certain example, we take direct labor and manufacturing overhead as conversion cost. Conversion cost means the cost incurred in converting the raw material into output. So that is the real value addition, of course, taken place in the manufacturing setup. That's called conversion cost. Conversion cost includes, other than direct material, all other things we include as conversion cost. So you may input direct material, direct labor, manufacturing overheads into process one. Then process one means here the process A. So process A may really get an output. Suppose you produce, say gram 50 yogurt cups. So you insert the raw material, maybe milk, maybe whatever the other necessary, material, packing material, and you add the labor and also manufacturing overheads or whatever the overheads incurred into the process. Finally, you will get the yogurt as the output. But there will be a position where this particular the basic yogurt may be processed further. So thereby, for that you may add different flavors for the yogurt. So thereby it's called the process B. So thereby now process B, the produced yogurt, output of A, and maybe certain flavors and labor and overheads will be, combined, and process B will process the material and you get the completed products. That's called finished goods. So that is the meaning of process cost. So thereby you see that whatever the inputs of B depends on process A. So thereby when you look at the process costing, a unique characteristic is each process depend on each other or the previous one. Process B depends on process A. If the process A is not giving any output, you can't continue the process B. Flow cost processing, so material, inventory, conversion cost. The word here, the conversion cost means what? Direct material, OH, all other, cost incurred in converting the raw material into the output. So thereby process one. From the process one, the output would be transferred to the process two. That output plus some other raw material will be insert, and you get the finished goods, and finished goods will be charged to cost of sale or the cost of goods sold account when the inventory really become become sale. So when it becomes sales, of course, that cost would be charged as cost of sales. How do you calculate the total cost? What we do is, in normal thing, total cost of the process, divide by number of units produced. That's the weighted average, simple weighted. Total cost you divide by the number. Okay, different scenarios are there. In this particular lecture, we will be discussing different scenarios. There are three scenarios, of course. One is process costing when all products are fully completed. So you don't talk about the work in progress. Whatever the processes, at any time, when you take any time, there may be, not completed items, items which are in the process. So thereby work in progress will not be considered under first scenario, but we will be discussing no loss within a process. That means no abnormal loss, no normal loss, and normal loss and abnormal loss and abnormal gain situation. So that is with without work in progress. Second one is process costing with work in progress exist. So process costing when closing working progress but no opening. So we will be discussing process costing with opening, closing WIP, work in progress, but not opening work in progress. And also process costing with both opening and closing work in progress. We will be discussing. And process costing when partially completed output and losses gains exit in the process. Even we will make little bit complex the second scenario by incorporating normal and abnormal, losses and gains into the case. So that is the scope of our discussions. We are discussing accounting treatments for all these three scenarios. Okay, process costing when all products are fully completed without work in progress. Assume that all output within each process is fully completed. Can be explained under following two scenarios. We have two scenarios, basically, normal losses within a process and normal and abnormal gain. Now, what I'm trying to tell you is that now from this onwards, we are discussing process costing without working progress, Okay, and with no losses and normal loss and abnormal loss and abnormal gains. That means we are discussing the scenario number one. Okay. Damit PLC is a manufacturing business which produce several products through continuous process as large batches. In the process accounting, you produce mass amount of items, not 1, 2, 3. When you produce, say, oil processing, you can I think there are examples here: chemical processing, oil refining, food processing, brewing. The method of costing used mainly in manufacturing business where units are continuously mass produced through one or more processes. Mass production. Whatever the item you produce, you see that equal, similar items you produce, but not one or two, but you produce large amount, mass production. Chemical processing, oil refining, foods, yogurt manufacturing, whatever the garment factory, t-shirts, shirts, all these are bulk manufacturing. Under process costing, costs are accumulated by department process cost centers rather than by orders assigned these costs uniformly to all units that pass through the department process during a peak. Now, unlike job costing, the cost incurred when processing, when we talk about the processing cost, we accumulate based on department or processes, meaning cost centers. But you can remember in job costing, we accumulated cost to the job 1, job 2, job 3, but unique jobs. If you go to a garage, if you go to a service center, if you go to a doctor, if you go to a hotel, if you go to a hospital, so you can consider, they consider you as a patient as a separate case, separate job. So thereby the customer, client, or the job will have a separate costing card. We call it job card or job costing. Now here it is opposite. We produce many number of items, but resource consumptions per unit is almost same. That's why we use the weighted average. Okay. Then I have a power cut. I know that I will be able to, I have the full battery charge in my laptop. So I hope I will be able to continue the session. Then, of course, next item, we are focusing on this example now. So through the process, and the following information is relevant to product beta manufacturing by this business. Inputs raw material 500 grams, cost of 1 kg raw material is 30, direct labor 100, manufacturing over 1150, output process is 200. We can just prepare a process account. In a process account, what you can say is you will see the units as inputs, and also in a process costing, the credit side, you will have the output as units, right? And also you will have the debit column, credit column. So that is the basic format of the process costing. So when you introduce raw material, you insert raw material. You can say this is the raw material, RM. I am putting as RM, raw material. So you put the raw material. Here you put 500 kg, 5,000 kg. We put the 5,000 kg here. If you want, you can put the kg even, no problem here. And 1 kg is 30 rupees. So thereby you see that the cost of the value is 150,000 kg. You are inserting to the system or the process. Okay. So that is how you prepare the process cost. That is with regard to the input. And also you see that you insert direct labor. Direct labor is 100,000, but you can't put the unit column here. We put only the raw material. In case of raw material, we put the units. And also you see production overheads. How much? Production overheads, again 150,000. So that is the cost incurred in your process, right? So that is the cost incurred in your process. So here, of course, you see that total you can take total cost, right? Total cost would be, around 400,000. As per the question, it says 200 output. You can put the 200 output as here. And so you see that this 200 units, by inserting kg 500, you get 200 units. So thereby this 2,000 units are, if you take one by one, all the units are equal. All the units are equal. So what you do is you just calculate, you just divide the 400,000 which is incurred as your cost, and you just divide by 2,000, so you get the output. So thereby, basically what happened is 1 unit is equal 200. So thereby, what you do is just 2,000 multiplied by the 200, the value, you get the this thing. So thereby, basically you will see that your process account is tally. That is the basic principle of uh, uh, process accounting. So prepare the process account. We prepare the process account and calculate the cost of units, the product beta. The cost is per unit is 200. How do you calculate? The accumulated cost 400,000, just divide by the number of hours. So thereby, so you can have the formula. Formula is always, remember, total cost, right? Total cost, right? You divide by expected unit. Expected units. Total cost divided by the expected unit. I would say one more thing, total cost minus normal yeah, no, yeah, not now. Okay, total cost minus expected units would be the cost you calculate. I think that is very clear, and this is the answer for the question which I have calculated. Okay, and then of course you will see the answer here. Yeah, quantity, unit price, amount, output, quantity, unit price, amount. So you can put the unit price also, no problem. There's no problem. There's no problem. Here the output quantity should be not 5,000. It has to be, there's a small mistake here. It has to be 2,000 as per the question. Okay. Shall we go to the next one? Next one is, we are trying to explain you the normal loss. And here you see that 500 kg you insert, whatever, maybe the milk, maybe the cloth, maybe whatever, oil, maybe anything. But there was no any losses, any wastage in the process. That is the mean, right? But when you continue certain manufacturing setup, what happened here is, when you continue certain manufacturing setup, what happened is normal losses and abnormal losses can be discussed. Abnormal losses and normal losses can be discussed. Okay, so just look at the slides. Just look at the slides. And try to understand. Normal losses inherent in the production process that cannot be eliminated under efficient operating conditions. Now here the idea is, you see, losses are there, but those losses, when you say normal losses, it is inherent. You can't control it. That's the nature. But when you go to the manufacturing garment factories, pieces of cloth, you see, you can, you will see the pieces of cloth. So thereby, those are the, normal losses. Abnormal losses means, it is your problem, management problem, inefficiency issues. Reasons may be poor working conditions, your machines are not good, you have worked as a careless, and rough handling, you don't know how to handle the material, low quality raw material, machine breakdowns and accidents treated. This is the abnormal losses we treated as an expense. It's a loss for us. But normal losses, weight losses, shrinkage, evaporation, when you process the oil and liquid things, I think you get the evaporation. So rubber manufacturing people, you get the latex and process it, but and also the farming industry also, you may see evaporations. We go example kitul, when you prepare the honey penny, you may get this evaporation, rusting, and that also example should be absorbed by the good output. So thereby we don't consider normal losses. We include normal losses, that loss incurred in terms of normal losses will be absorbed by good items or the completed items. So thereby normal losses we inbuild in finished goods or the completed units. But abnormal loss, we take it out separately and we show at it as an inefficiency of the expenses. Normal loss and abnormal loss gain with the process. So one example, just read the example. Just read the example. Just read the example. Okay. Now, Colombo PLC's manufacturing business, which produces several products through continuous process as large batches. The following information is relevant for to product Sigma manufactured by this. This is the Sigma manufacturing. Raw material 2000 kg. I'm just using the same account. It's easy for me. 2000 kg you are now inserting, right? Kg, you are inserting 2000 kg. And cost would be 50,000 per kg. So thereby here the answer is, you see, 50 rupees into how much? Into 2000. That is, I think, 1 million. Basically, not 1 million. Yeah, you see, 1 million. It is 100,000. I'm sorry, 2000. No, 100,000. The cost of the raw material and conversion cost. Conversion cost means both direct labor and the overhead. So thereby here they have one line. I write conversion cost. Conversion cost means CC. Conversion cost. The conversion cost in this example is 75,000. I put the 70,000. So altogether you see that your cost would be 175,000. And there's a small statement, normal loss 10% of the inputs. So input is 200 kgs. So 10% means, how do you calculate 10%? 2000 into 10%. That is, basically 200. So that is the normal loss. We call it normal loss. Remember, normal loss. Normally loss is so much. And then what would be the output? Output is, you see, 1720 output. So what you did was, you insert 200 kg. You know that 200 kgs are 2000 kg, and normal loss is 2000, and you got the output at the end 1720, right? So you see that here the total is, here the total is 2000. Okay. But here the total is not the 2000. You see, here the total is something else, 1980. So 80 is missing. What is this 80? This 80 is coal. Even though we expect 200, our extra, our issue, our problem, our process had a small problem, we will end up with another 8 units loss. We call it abnormal loss. Abnormal loss. That is the abnormal loss. Is it clear? Okay. So that is the account. Now our question is, Now our process costing means this. What is the cost of this? What is the cost of this? And what is the cost of this? That is the objective purpose of process costing, valuing output. So you can remember normal loss is a kind of inherent to the process, thereby their value is zero. You are not assigning any value to this. And your total cost is, we are applying the data to the formula. You insert how many units, how much cost? 1755, 175 you insert. How much you expected? You insert 2000 and really you expect how much? You expect normal loss is 10%, so you expect 90%. You expect 90%. So thereby, you see that 1705 divided by 2000 into 90%. So thereby, you know the answer. එතකොට 1,75,000 අපි බෙදනවා 90ක් කියලා කියන්නේ 1800. So that is the cost. So thereby cost is 97.22 unit cost. So thereby what you do is you multiply this output 1720 by the 97.22. Okay, and you multiplied 80 by how much? 97.22. That is the costing. So thereby, if you go to the answer, calculate the normal loss and abnormal loss in quantities. Normal loss is 200, abnormal loss is 80. Calculate the cost of normal loss and abnormal loss. So normal loss cost is 0. Normal loss cost is 0, and abnormal cost is, how do you calculate it? I have given the formula logic 80 into this 97. So that is so much. And here the value of the finished goods would be this into this. Okay, so when you add this all together, your value should be equal to what do you call, yes, 175,000. Is it clear? So that is the logic of that is the logic. Okay. Then the last question, prepare the process account. We have already prepared the process account. This is the process account. This is the process account. And scrap sales account and abnormal loss account, assuming that there is no scrap value losses. So with regard to this scrap means damage item losses, there is no value. So thereby what we do is we can prepare only one account, that is abnormal account. Abnormal account. Here when you write abnormal accounts, so abnormal account would be 777 debit, saying that process account, process account, and this will be charged to P&L as a separate item, 777. So that is the entry. Okay, shall we just look at the answer? That is the answer. So we abnormal loss account, here you credit the process account and here you debit. Here you debit. and you charge the P&L this. There's no scrap value. Scrap value account is 0 here. There's no value here. Don't worry about that. Okay. They have prepared, but since there is no value, they have put the 0. Cash good debit, scrap value account credit. Here, 0. But that such an entry is not required. Shall we come to the next one? Normal loss and abnormal gain within a process with and without a scrap value. So we will develop the 5.2 example a little bit further. Consider all the information given in 5.2. 5.2 is example is this. I think you can remember, right? So the question 5.2, and prepare the process account, a scrap sales account, abnormal loss account, assuming that every loss of unit has a scrap value of 10 units. If that is the case, what happened is just minor changes. Of course, you know that since the account, since the 5.2 information is correct, there is no change in this part. And there is no change in this part also. But the problem here is the values will vary. Values will vary. That is the only thing. So thereby, what is our question? Our question is, what is the value here? Right? What is the value here? So with this new information, what is the new information? Normal loss and abnormal losses, whatever the losses incurred, have a 10 rupees value, unit value. So meaning is that this 200 can be sold at each unit 10 rupees, and this abnormal loss 80 can be sold at, you know, each unit 10 rupees. So if that is the case, what we do is we do the basic calculation, total cost expected unit formula. And here this 175 is not changing. But remember, since we have a scrap value, what we do is we have to reduce the scrap value from the cost incurred. How do scrap value is how much? 200 into 10. That we are deducting. Are you clear? Hope that you are clear what I'm telling. And expected unit, there is no change. So thereby our cost calculation, unit cost calculation, what would be the formula? 175,000, which is cost incurred minus the value of the normal loss. Scrap value of the normal loss. Scrap value of the normal loss, not the total loss. Here the total loss is 200 to 80, 280. But we don't take the total loss, we take only the scrap value of normal loss divided by the expected units. So what is the answer here? So thereby I think you will see that you have to minus 200 into 10 means 2000. 2000, no? So you have to minus 2000 from this, then you will get the unit cost. Is it clear? So unit cost would be 96.11. Unit cost would be 90.611. So then how do you are going to value it is this, instead of 97, now new unit cost is 96.11. Okay. And here 80 rupees will be valued at new unit price 96.11. That is the idea. So thereby your values would be vary. Here the value would be now, remember the value would be now 2000. Okay. And here would be this 1220 output, right? 1200 output multiplied by unit cost, which is this, and that would be the answer. And here also same 80 units abnormal loss into the unit cost of 96.9. So that would be the total. Total cost would be, then your account should be tallied with these figures. Is it clear? So thereby what I'm trying to tell you is that basic formula total cost divide by expected units. Now we are slightly modifying. Total cost is same, no problem, but we minus scrap value. Scrap value of, right, normal loss. Scrap value of normal loss divide by expected unit. The formula will slightly change if there is scrap value for the losses. The basic formula slightly change. What is the slight change? Total cost minus scrap value of normal loss, right? Then divide by the expected unit. That's what we did here. That's what we did here under 5.2. Right? Prepare the process account. We have prepared now process account. An abnormal loss account, assuming that every loss unit has a scrap. Now, abnormal loss unit will be little bit changed. Okay, abnormal loss is now little bit changed. Now, what we do is we transfer these, we transfer output, this one to finished goods. There is no problem. We call finished good account. Finished goods account. So you transfer that to the finished good account, this one. And you transfer the normal loss to the normal loss account. So thereby you will be opening a separate account called normal loss account, right? Normal loss account. Normal loss account. So for the normal loss, what you do is you write the process account, and you debit the amount 2000 here. 2000 you debit. Okay. And you see that since you receive the cash amount of this much, you debit the cash account, say in cash, and you debit the cash 2000. So thereby your account would be closed. So what is this this entry? You can transfer it to here and you can debit the cash account. Okay. Then abnormal account, you debit by process account saying how much? 7688. And so you know the abnormal value is 80 units. And you have the cash now for that. You can sell this 80 units, even though it is abnormal units. You can sell these 80 units by how much? I think 10 rupees. So thereby you get 800 units, 800 rupees as, you know, credit entry. So what happened here is your accounts balance, you can close the account 7688. Here also 7688. 7688, and the balance would be the P&L amount. You close the account to this one, so the balance would be really the amount of debited and what is credited. The balance would be P&L. You charge the P&L 688. So with this 1.2 scenario, we make it a little bit complicated. We add scrap value. When the scrap value is there, remember your process account will be credited by the scrap value you are going to get, and that will be debited to the normal loss account. When you receive the cash, you debit the cash account. Normal loss account will be automatically closed out. Okay, but abnormal loss account, you see there is an entry. You debit the loss, that is true. This is the loss, and you recovered 800 from this loss, but you will end up with this amount of 688 loss, which is being transferred to the P&L. Okay, I think we can look at the example. podi decimal වල වෙනසක් තියෙනවා. Don't worry about decimal issue. Other than that, same answer here in the process account. You see, total cost will be calculated 175,000 minus the scrap value of normal loss, which I developed in my second formula. Okay. Right. Shall we move on to the next one? Normal loss and abnormal loss, abnormal gain within a profit. Now we are introducing another concept called, we introduced the normal loss, we introduced the abnormal loss, and we discussed the normal loss and abnormal loss with scrap value. Now we are discussing abnormal gain. Abnormal gain. Gain in a process, when the actual loss of process is less than the normal loss, that difference is referred as abnormal gain, arising due to effectiveness in handling raw material, efficient labor performance, a negative cost, a reduction in the normal loss. Now, abnormal loss means we didn't expect such a benefit, even though we expect 10% normal loss, but actually normal loss was 8%. Maybe due to using good material, your employees' motivation, your employees' capabilities, new machine situation, the technology story, health, what they call weather condition of the manufacturing setup. So whatever the things, due to these things, even though you expect little bit amount, little bit normal loss, but your actual loss was below the normal loss. So then in such situation, you will get the abnormal gain. So we will take one example with an abnormal gain. Okay. Candy PLC is a manufacturing business which produces several products through continuous processes as large batches. The following information is relevant to the product beta manufacturing by this business. If you have so far any question, I can answer. Any question? No. You can put it to the chat box. I know that there are 6 students. What to do? I don't mind. I will continue the lecture. Input of raw material. Here I put raw material instead of 2000 earlier case. Now it says 1500. Right? So those are the data we are entering. And the raw material kg is 60. 60 how much? We can calculate it, no? 1500 into 60. 1500 into 60. How much? Yes, that would be the 90,000. And conversion cost would be 50,000. Here I am changing the data, just I am changing the data. It is 50,000. So altogether, you will see the total cost incurred for this process is 140,000, right? And it says normal loss is 10%. Normal loss 10% means how much? 150. 10% into, how do you calculate it? 1500 kg into 10%. We don't know the value here yet. And we don't know the value here. And I'm deleting this data. This one also I'm deleting. Right? What I did was I entered the question data given in the question. Input of raw material, so much. Cost of raw material 60. I calculate the value of the raw material. Conversion cost I insert. Then it says normal loss 10%. What is input? Input is 1500. So I calculate 10% out of that, 150. And output process is 1400. 1420 is the. Now you see that here, even though it is you see the total. I'm just putting, okay. Here the total is okay. Now you will understand there is an imbalance between input column and the output column. Okay. I'm sorry. Anyway, this is it has to be 1570. Okay, because this side is now, this unit credit side is more. So you see here, there is line item now. There is no abnormal loss, right? Here there is an abnormal gain. Abnormal gain of how much? 70, which we didn't expect. Even though we expect 150, our actual expectation was not that amount. It's below that. So thereby we end up with the abnormal gain. What I'm trying to say is, when the unit side, credit side of the process account, unit side of the credit side of the unit column of process account is more, then you will end up with abnormal gain, right? And we will continue the question. Calculate the normal loss and abnormal gain in quantities. There's no scrap value here. So thereby there is no scrap value. So thereby value here is 0, since there is no scrap value. And our formula is, you can remember, what is the formula? Total cost, scrap value of normal loss, expected units, right? So what is the expected unit here? Total cost. Total cost is 140,000. I'm just putting. There is no scrap value. What is the expected value? Expected value is, you insert 1,500 and you expect 90% multiplied by the 90%. Is it clear? 90%. Just see the 90%, not the 90, of course, 90%, no? 90% percentage has to be put, right? So can you understand what I'm telling? So we apply the data to the normal basic formula. Total cost, scrap value is 0. There's no scrap value. And expected unit is, since you insert 1,500 kg, 90% expected. So thereby, what is the answer? Answer would be 140,000, right? Divide by how much? 90% means, of course, 1,350. So thereby unit cost is 103. So we can put the unit cost here. You can value the inventory. How do you value is this unit multiplied by the unit here. So that is the answer. Okay. And also you see that here there are 70. So what is the value of this 70? So I'm putting the question mark. So what is the 70? How do you calculate it? Very simple. What you do is, you just take this 70, right? Take the 70 and multiplied it by unit cost. What is the unit cost here? This one. That's all. So your answer here is, right? Are you clear? Your answer is 70, right? Units abnormal loss multiplied by the 103. I'm again putting, right? So thereby you see that process cost accounting, debit column and credit column is tallying. Is it clear? Now what you have to understand here is, even though we expect 150 units normal loss, we didn't get that much of loss. Our actual loss was 150 we expected, minus 80 abnormal loss, our actual loss, not the 80, 70. Our actual loss was really 80. This is the actual loss. So we will end up with 70 abnormal gain and normal loss so much. So calculate the normal loss and abnormal gain in the quantities, that is 150 and 70. Calculate the cost, normal loss, abnormal gain, assuming that there is no scrap value. So we calculate value of the normal loss is 0 and abnormal gain is 7,259. Calculate the cost of normal loss and abnormal loss gain, assuming that every loss unit has a scrap value of 8 rupees. Then, of course, for this question, we can prepare the abnormal account. Normal loss, we don't get the normal loss account, right? We won't get any normal loss for this question. You have to remember, I am deleting that data, right? But you can prepare the abnormal loss. Instead of abnormal loss, you will have an abnormal gain account. Instead of abnormal loss account, you will have an abnormal gain account. Okay. For that, of course, there are no, of course, debit entries, right? No debit entries. What will happen here is, since you have credited the process account, sorry, debited the process account, right here, process account, right? You debit the process account and you credit the particular account. What is, how much? 7259. 7259. Then this will be charged to the P&L. That is the normal abnormal gain account for this scenario. Okay, all right. Then part B, you see, there is 8 rupees normal loss per unit. Then what happened here is this calculation will change because you have the scrap value. Now what I will do is I will change it slightly. Now what happened is 1,040,000 minus 8 rupees into 150. 150 into 8 rupees. Is it clear? That is the scrap value. That is the scrap value. But this one will not change. So are you clear? So what I'm trying to say is 140,000 minus the scrap value, that is 150 into 150 into 150 into 8 rupees divide by 1,500, 90%, which is expected units, our formula. So if you apply data to this formula, what happened here is I should minus 1,200 1,200. So what I will do is I will put a bracket to get the solution here. So the unit cost would be now 102. 102. So the answer would be here. What happened here is I'm just putting you, I don't know whether you can understand what I'm doing, right? 1,420, okay, multiplied by unit cost of this, which is this amount, right? And this one would be little, again, you get the same answer, but I'm just telling you how to calculate it. 70 into new unit price, which is this. So thereby again, and also you see that that is the value of this normal abnormal loss. Okay. Value of abnormal loss and value of finished goods. But here, since normal losses are having a scrap value, so 150, right? 150 into 8 rupees, right? 8 rupees would be the income. Okay. So thereby your account is now tallied. So we will prepare the abnormal account now and the normal loss account. Since we are getting this 1,200 from the process account, you debit it saying that process account. How much? 1,200. Okay. But what would be the cash? Are you getting that much of cash? Did you receive any 150 units abnormal loss? No. Sorry, normal loss? No. The cash would be thereby actual what you received is not the 150 minus the abnormal gain 70 rupees into 8 rupees is the cash, right? 150 150 කියලා කියන්නේ normal loss units ගාන 70 කියලා කියන්නේ abnormal gain එක units වලින් multiplied by 8 rupees, that is what you are getting. So thereby you enter the formula 150 minus 70 into really we have to put a small bracket, otherwise our logic is wrong. No? Oh my god, what happened? Yes, 150. Okay, that 8 rupees. That is what you get as cash. So you see that normal loss account, there is a difference. Even though we counted 150 units, of course, we were able to sell only 80 units, 150 minus 70. So thereby, there is a difference in the normal loss account. How much? That is the difference between this 1,200 and this 640. So what we will do is, we transfer this into abnormal gain account. That is the entry. You have to remember, abnormal gain account. You transfer that loss into abnormal gain account. Abnormal gain account will be debited by 560, saying that not P&L, normal loss account. Normal loss account. That's what you say. And there is a difference in the abnormal gain account. That difference will be charged to P&L. That difference will be charged to P&L. So this 699 will be charged to P&L. That is the logic. So what I want to communicate to you is that when there is an abnormal gain, of course, normal loss is less than what is expected. In this example, 150 normal loss we expected, but actual is not 150, actual is 80, because we got 70 units of abnormal gain. Okay, right? So thereby, in an abnormal gain situation, remember, normal loss account is not balancing. There is a gap between process account debit amount and the cash received. That gap will be transferred not to the P&L, the gap will be transferred to the abnormal gain account. That is the logic. So the balance would be charged to the P&L account as a benefit, as a gain to the income statement. Okay, shall we continue? Now that is the answer. That is the answer. For the this is the answer for the first scenario. This is the answer for the second scenario just completed. 150.997. Okay. Any question? If you have, I can write. Now you have to, if you didn't follow this series, you can't get it very quickly. This is little bit, we started with very simple scenario, and we are moving to the complex scenarios now. Okay. Normal loss, abnormal gain with a process with and without scrap value. Again, there are two processes now, not one process, not one process. Process A and process B. If that is the case, we will see how to account for this particular account. Now we have to prepare the process account. Now process A is with me. I am just preparing the process A account. Evergreen is a manufacturing company which produce product alpha. This product passes through two processes, process A and B. A loss of 5 is allowed in process A and 2% is process B. Nothing being realized by disposal waste sale. That means there is no normal, there is no scrap value. During the April 2020, 10 units, 10,000 unit material costing 6 per units were introduced into the process A. The other costs are additional material, process A, additional material is not there, labor 1,000, 10,000 and overhead. So I think it's very simple. You can prepare the process account. Raw material units instead of 1,500 in this new scenario, 10,000 units, not the kg, 10,000 units. Okay. And since 1 unit is 6 rupees, the value would be not 90,000, it would be 60,000. 10,000 into 6 rupees. And here they have changed the things. We have the direct labor. Of course, direct labor is 10,000. Okay, direct labor 10,000. And also we have the production overheads. How much production overheads? Production overheads is 6,000. 6,000. Production overhead 6,000. So altogether, total cost is 70,000, but here 10,000. Yes. I just put the 10,000, but we will see what it is later on. What is the output? So it says that 5% is, normal loss. So 10,000 into 5,000 means 5% means how much? I think it's 500 units, right? We don't know this one. I'm deleting this data and this data, right? Output of the finished goods, they say the output was 9,300. Here 9,300. We put the output. Okay. Now you see unit cost column. We can with regard to this process A, we can close the unit column. 10,000 debit side, and here 9,800. So thereby there is a abnormal loss. Are you clear? Abnormal loss, how much? 200 units. Then your, unit columns tally. Okay, 10,000, 10,000. Now, what is the fundamental question? Fundamental question is, what is the value here? And what are the values for completed units and what are the values for abnormal loss? I think, yeah, with me, since there is no scrap value, here the value is 0. And we apply the data to the basic formula. What is the formula? We apply the data to the basic formula. Can you tell me the formula? I remember. Yes. What is the formula? Formula would be the cost incurred, that is 76,000, neither 76,000 divided by expected units. What is the expected units? Can you tell me expected units? You insert 10,000 units and you expect normal loss of 5%. So thereby you expect 95%. 95% means from 10,000, 9,500. So unit cost is 8 rupees. So thereby you can fill this column. What is the column? Here, this 9,300 finished goods multiplied by 8 rupees. And here, of course, 200, the units multiplied by 8 rupees, right? So I think with this, your total column should tally. No? $76,000. So that is the process A account. Process account A. Are you clear? We just put the data in the question. Very simple. Completing this part is very simple. Completing this part is very simple in a process account, and completing this part also very simple. And only question is, what are the values for these columns? So you have to find out the total cost, unit cost. Unit cost is 8 rupees. Just multiply these figures by 8 rupees and your account will be balanced, right? And you can prepare the normal loss account. Is no need to prepare because there is no scrap value. And what you can do is the abnormal loss account. You can have an abnormal loss account here, not the abnormal gain account. You will have the abnormal loss account, right? Abnormal loss account. And what you can do is you will debit the loss, abnormal loss amount to the, say in process account by how much? 1,600. And you charge this to the P&L saying that 1,600. That's how your account system for the process A. This is not relevant for a because we don't have the abnormal gain here, thereby it's not relevant for us. So this is the answer for the process A. Process A. And remember, this output finished goods, this is not being transferred to the output finished goods. This will be transferred to output will be not for finished goods, process B. That you have to remember. So that will be transferred to the process B because there is a process B account, right? So we can open now process B. We are preparing the process B. Process count, neither B, maybe process, whatever things. So first entry would be from process, neither process A. How much? So you get this amount here, 74,400. What you are writing here, but how much you are transferring? 9,300 units. So thereby unit column also you can fit. Are you clear? Process A and process B. You are transferring this much to this one. You are transferring this much to this one, process B. And additional informations are given. Material, raw material, they are adding raw material to this process, which is 6,140. Okay, 6,140. And also you see that labor, direct labor, I will put direct labor is 6,000. I'm just preparing the process account B. And also you see that overheads. I think my battery is becoming low. 30 minutes remaining. When battery is over, disconnected, so session is over. We will start the next session next day. Remember, 4,600 if the current came, no problem. Okay. So from process A, so much. Process B, so much. Sorry, process A, raw material, direct labor, overheads, and we get the total. So total would be how much? Yes. Total would be 91,400. Then, as per the question, 2% is normal loss. So thereby, you have to calculate the normal loss amount. Normal loss. Okay. Normal loss, how do you calculate? 93,000, 9,300 into how much? 2%. That you have to remember. Okay. 2%. Again, here 2% came again. So we will see 9,300 into 2%. 2% is the 186. Then, as per the question, it says that the B output is 9,200. Finished goods. Finished goods. How much? 9,200. So now you can here you can get the total, of course. What is the total here? You see, total here is 9,386, which is more than 9,300, which you introduce. So thereby what happened here is you have a abnormal gain. Abnormal gain. How much abnormal gain? 9,386යි 9,304 වෙනස 86යි. So you put the abnormal gain. That's all. That's all about the accounts. But next question is, what are the values here? Question mark. No? Here, here, and also here. What is the value? So what we do is, we use the total cost incurred, that is 91,140, divide by expected units. Expected units. You have to remember the word expected units. Right? How do you get the expected unit? Okay. Expected units. How do you get the expected units? Divide by expected units means 9,300 into 98%. 960 pattern. So I will remove the equal sign, then you can remember the formula. The formula is the total cost incurred divided by the input 93,000 and into 98%. That is the expected units. The expected units අපිට ගන්න පුළුවන් ඇත්තටම කීයද කියලා. Expected units කීයද වෙන්නේ? මෙන්න මේ 9300න් 186 අඩු කරත් හරි. එතකොට වෙන විදියකින් මේක ලියනවා නම් 91,140 divide by bracket 9,300 minus 186. You can write this way also. Same thing. Same thing I have written. So thereby, basically 10 rupees. So what you do is here, this will multiplied by this column multiplied by the unit cost of 10 rupees, right? And this column also multiplied by this one multiplied by the 10 rupees unit cost, and also this 86 rupees also abnormal gain 86 units multiplied by the 10 rupees. So your account should be I hope that this account should be telling. Yes. Okay. When you take the total, that has to be tallied, otherwise there's a What is the problem? No, I'm sorry. For the normal loss, we don't put a value because it's zero now. Scrap value is not there. Can you remember? It's zero. So thereby your account is balanced. So no need of putting a value here because there is no scrap value. I think now I'm almost I have done up to 5.5. So what we will do is we will continue since I have only 22. I don't know because recording will be upset if I continue. So we will stop here the lecture and we will continue the balance part next week. Thank you very much for joining. Even though there are 6, we will see. There's a question. Okay. Thank you. I know that if you are difficult to follow, so when I explain it, even though you may be clear, but it's required for you to practice this, understand the logic principle, then it will be easy. But next questions, next part of the session would be a little bit advanced, complicated, with opening WIP, with opening and closing WIP, weighted average. So far we did the weighted average. Make a weighted average. Cost divided by the number of units, assuming that all units consume same amount of resources. So thank you very much. Then we will meet next time. Okay, bye.